Like I had somebody recently reach out to me because there's been a bit of a sell-off in equity markets the last couple of weeks. I don't know if you've noticed. And they said, should we move it all to bonds right now? I think we're going to get a few more of those questions. Like, should we be more nimble? Should we be, getting out before it gets worse? And I remember years ago, I had somebody who did just this, or they wanted to do this. They said, I really want to sell out. I said, okay, why? They said, well, I'm scared. So I totally understand why you're scared, but so you're going to sell out now when it's low, and then what? What are you going to do? And they said, well, when it gets better, I'm going to buy back in. So I said, okay, let's just think about that for a minute. You're going to sell out when it's low, and you're going to buy back in when it's higher. That doesn't seem to be a good recipe for success.
It's a great selling point of, oh, you got to get out or you got to get in. It's really just a sales pitch. Nobody knows how to do it. It's the old Warren Buffett comments that, if you're going to buy something, imagine the stock market's closed for 7 to 10 years.
Exactly right. Stay invested because, even missing a small number of the strong days in the market can have a huge impact on long-term returns. And we've done this data in the past as well. So I won't take everybody through it today, but basically if you miss the best 10 days in a 10-year cycle, you miss out on tons and tons of return, right?
Yeah. And if you have, kind of going back to our point before, if you have a diversified portfolio, when we say, well, markets are down, not every asset class is down.